Welcome to another episode of the Straight Up Chicago Investor Podcast. I'm Tom Shellcross, licensed agent with Second City Real Estate. With me, as always, is Mark Ainley, owner and founder of GC Realty. Mark, what have our listeners been doing?
You guys have been referring us out, and I just want us to take the minute here to recognize that our numbers in the recent weeks have gone up. A lot of our older episodes have been being listened to. I don't know if it's coincidence, but I know I've been on here asking everybody to refer us to a friend, and that's what makes the difference. And I'm assuming that's happening. So we just want to take the moment here to thank all of our listeners for sharing this with your network. And if you are one of those that haven't yet, then just feel bad that other people are and you're not. So thank you, though, from everyone behind Straight Up Chicago Investor Podcast.
Yeah, the numbers have been real good. We've been asking and you guys have delivered. And that's how we're able to get these guests. When these guests who have publicists, the first thing they're going to say is, what are your downloads? What is this? They go and look at our reviews. So we're not just asking for this vanity thing for me and Mark, ooh, look at our downloads. It is important for us. And I know it is a vanity thing for Mark as well. Every Thursday, he's checking that thing hourly to see where we're at. But no, we appreciate it. And it's cyclical. It'll continue. It'll allow us to keep providing, great guests who provide great content.
Listen, the data for the show downloads, it's the data that really gets me excited. Don't get me wrong. I appreciate the downloads, and I do enjoy seeing that number, especially when it's growing. But I love the fact that you can see where it's coming from, what type of, if it's Android or if it's Apple, I don't know, all the data behind it is what's fun about that website.
The funnest part is, not to go on a tangent, but you can see what countries, and you can see every week there's one dude in Croatia downloading the episode religiously. Yes. You look at these countries and every week goes up by one. It's one guy sitting there, some expat who's religiously listening. And if you're one of those people, please call in or email us. We'd love to talk to you.
Yeah, for sure. And there's these countries that pop up there in Africa, and it's so good or bad, but however it sounds. I just picture some guy in a hut, listening to our podcast. I love that idea.
So awesome. No, we really do appreciate it. So with that said, we're providing value. Mark, what's our housing provider tip of the week?
Well, the cool thing that is available now that was not available 20 years is how cheap lighting with LED and these LED, wireless type fixtures. Lighting has gotten so cheap. And I say that because security has become so much more of a conversation lately. There's a lot of crime in the news. It's in social media. It makes headlines. Sometimes it's not legit. Sometimes it's just headlines. But no matter what, that's in people's minds. That's in your tenants' heads that this world is less safe. And for whatever it's worth, it's really it's a lot cheaper these days to provide lighting. Lighting is the best way to deter, and you ask any police officer to deter crime at night, is just to have the place well lit. So all these different LED options you have out there, wireless or not, it just makes it so much easier to provide that for your properties.
Yeah, absolutely. Easy. It's one of those easy ones that gets overlooked. So, all right, let's jump in. All right. So this is going to be a very insightful episode because our guest today, he's done it as a multifamily broker. He's done it as a GP, an operator, as a limited partner, and he's done it in Chicago and in other markets. So we're going to objectively compare how those properties are doing in other Midwest markets and Chicago, which I think will be just a lot of knowledge. And we haven't touched on a lot of this. But our guest today was on episode 14. Mark, that aired over 2 years ago. So he's bringing us back probably a little more hair
apartment when he filmed it, if I remember correctly.
Yeah. So 2 years later, he's back. And that's a great episode. If you invest in the Southwest burbs, our Tinley Park, our Oak Lawn folks, go back and listen to episode 14. But our guest today, managing broker at Essex Realty Group, their leading multifamily brokerage company that sold over 1,500 apartments last year alone. He has 15 years experience as a commercial real estate broker and has been involved in over 750 million real estate transactions throughout his career. He's a principal at ARC Equity Group. It's a Chicago-based real estate investment firm that specializes in acquiring and operating apartments in the Midwest. He's a general partner in over 500 units and then a limited partner in another 650 units with a total approximate value of $90 million. We're getting close to the B word there. So without further ado, welcome back to the show 2 years later, Brian Kochendorfer. Brian, how you doing?
Good, guys. Thanks for having me back. Seems like a whole new world since we last talked.
Yeah, we were in the heart of COVID when we recorded last time. We were joking. We recorded in mass. We didn't do that really, but that was the heart of COVID when we did that.
remember sitting in the home office at the time and just not knowing what to expect the next few months.
So, Brian, we're not going to recap how you got started. We did that on the original episode, but just to give our listeners a quick taste, let's talk about the jump from just being a broker and brokering deals to investing. Not every broker makes that jump. So what attracted you to the investing side of the equation? And let's talk about some of those original purchases.
Yeah. So initially, I had always gotten into brokerage with the mindset that I wanted to grow as an investor. I wanted to learn about real estate, multifamily, understand how properties operate, and use that experience when I go to acquire myself. So, in the 2015, 16, 17 range, I started investing as a limited partner just to build up some passive income while I was doing the brokerage. And then 2018 and 19, I believe, is when I started first acquiring a couple properties just locally, Northwest Indiana and Chicago area.
Got it. So what were you looking for? Like where'd you set your flag? Like, I want this size building. Like what was the parameters?
Initially, the parameters was to focus mainly on the Indiana market. I wanted a market that would not compete with brokerage activities that I was doing in the Chicagoland area, but that I can also get to in a day and back if I needed to. So we focused on Northwest Indiana and Indianapolis initially, and that's where we started acquiring our first couple properties. Once I started looking, I had a couple opportunities to partner with some friends of mine who were also acquiring properties in both, south side of Chicago, as well as, a little bit in the suburbs. So initially the goal was Indiana.
Got it. So we make a purchase in Northwest Indiana. I know you made that purchase in South Shore, I believe.
Correct.
Yeah. And I think that was pretty relevant, pretty recent at the time when we first interviewed you. Let's start there, because during this episode, we're going to objectively compare some of these different markets. Talk about the performance of that. Take one of your Northwest Indiana buildings, take that South Shore building, and if someone asks you like, well, which one's doing better? What do you like about that one? Like, let's kind of go down the line of comparing the two.
Yeah, so it's interesting. They were both acquired at the tail end of 2019. So about 90 days before COVID really kicked in and all the shutdown started. And Perfect. Both of them were pretty heavy value add properties. The South Shore one was acquired, I think it was almost half vacant at the time. So thankfully we got in to renovate 13 or 14 of the 30 units right away before COVID started. And most of those started leasing. And then in the Northwest Indiana property, we had started a pretty heavy value add program there. It was a 100-unit property, and we ended up renovating almost 65 units in the first couple of years. So that process went a lot slower just because that was occupied when we bought it. The South Shore one, being half vacant, we got pretty far into the renovation process. However, in South Shore, it's very Section 8 heavy there. So all of the inspections, the city inspections, we had an approved tenant, but couldn't move them in for 2 or 3 months sometimes because we had to wait for the city to come out to inspect it and go through the CHA process.
Got it. Even without COVID, you are going to lose a month there regardless. Like there's still going to be a holding cost, even in, I'll call it quote unquote, normal times.
Yeah. And that month went to 3 months, where in the Indiana property, we were able to turn around and lease right away. We had no problem with that because we don't do Section 8 out there. And at the time, they only slowed down evictions for the first few months, but we had far fewer issues in that market at the time than we did at South Shore. But for the most part, we actually got through it all pretty much unscathed, which is, pretty happy with how it all shipped out.
That's awesome. So let's talk some nuances here, right? We know a lot in Chicago. Most of our listeners know you're going to deal with taxes. You're going to deal with getting a tenant out is going to be a huge pain in the ass. Like we know either firsthand or from listening to podcasts like this, the headwinds against you. But now that you've been in another market, what are some things where you're like, ooh, maybe this isn't that bad?
I'm really bullish on Chicago right now. And we talked about this a few weeks back, but I would say a couple of key differences in Chicago versus, say, Indianapolis market, or Cincinnati, which we also own a property there. First of all, are deal terms. When you're making an offer in a Chicago property versus one of those types of markets, the deal terms are a lot different. Anywhere from earnest money to access periods and finance contingencies, completely different worlds. Also, the competition.
Wait, let's dive deep. I don't want to cut you off, but let's dive deep there. Give us some examples. Let's, if you could, get some tangibles here.
So if you're going to look at a property in Cincinnati, Indianapolis, or Columbus, or really any of those other states that people consider growth states or red states, over the last 24 months, almost every offer had some form of hard earnest money upfront, which means that you're putting down $50,000 or $100,000 upfront non-refundable at contract signing. Now, most of those contracts would allow for a short early access period in which you can go in and see a handful of the units and do a quick financial review. But then you're taking the property subject to as is, unless there's something wrong with survey, title, or environmental. So that's a huge difference. Just to play, especially in any of the bigger properties, call it 5 million and up, you're coming in with $50,000 or $100,000 hard earnest money day one. So that's one major difference right there.
So real quick though, it's almost like, I'll call it attorney review. Like you have the 5 days to get your act in order. And after that, regardless of your financing falls apart or anything, like you're on the hook for whatever that original earnest money deposit was.
Exactly. And there's really no financing contingencies in those markets either, not in the last couple of years. It's starting to shift a little bit now, the last 90 days, just with the interest rate market going crazy. But over the last 24 months, almost no property had any kind of finance contingency.
What's the reason behind that? Like, what do they see in those markets that they do? Is it just that hot of a market? Like, what's the story behind that? I'm curious.
I think one thing is because there's a lot of national buyers coming into those markets, where in the Chicago area, it seems like it's more local buyers. So there's buyers from the coast that come into Chicago, especially into the South Side market. But for the most part, in the North Side or the suburban markets, it's mostly either local buyers or people who already own properties here, even if they're not based locally. Where in Indiana, Ohio, markets like Texas, Denver, Atlanta, Phoenix, there's national buyers coming in from all over the place. So the competition is a lot higher. And a lot of the larger groups as well, the more institutional ones, they're going into those markets as well.
Got it. So give us an idea on competition. Let's pull on that thread a little. I don't want to take words out of your mouth, but I got to assume that that's also different comparing between Cincy, Indy, and Chicago.
Absolutely. It's a completely different ballgame. Not just hard earnest money and the finance contingencies, but you really have to have a good relationship with the broker in those markets. I think far fewer deals trade off market. Most of them come onto market in Indiana and Ohio specifically, where we bought. And those properties, you have to have a great relationship with the broker. You have to prove that you have a track record and that you can close. And a lot of them, they give you a questionnaire to submit with your best and final offer. And included in that questionnaire is how many properties have you bought in the last 3 years? How many closed at purchase price? If you backed out or had to renegotiate the price, what was the reason for it? Do you have your financing in place? So it's completely different. You don't see that as much here in Chicago.
I also like that. As someone who's on the sell side, sometimes on the sell side, it's like, let's start vetting these people with questionnaires.
Oh, yeah. I like that too. Yeah.
I have all kinds of buyer questionnaires if you want a copy of ones.
We did that. I know our office was doing that with when they only had a certain amount of weed license, the marijuana distribution licenses. All these guys were coming in from out of state, swooping in, putting these buildings, these under contract industrial buildings. And we basically were charging them a fee per month to keep it under contract and hard money. So I understand the concept behind that.
Yeah. Another difference too is over the last 12 months, specifically when interest rates were low in 2021 and just the market kept heating up, buyers were coming in and making offers sight unseen. So they were, out of state buyers making offers. They might have a portfolio there. Sometimes they had no portfolio in that market, but they would be making offers sight unseen. They'd have hard earnest money attached to the contract. And then if they got awarded the LOI, then they would have somebody go down and check out the property during the early access period if they had one.
Yeah. So I'm assuming to them, it's just like an expense. Hey, 1 out of 5 of these are going to fall out of contract. And we just have a slush fund of, a couple $100,000 for when that happens.
Yeah. And what people would do too with the hard earnest money, they might say, okay, there's $100,000 non-refundable at purchase contract, still subject to the title, survey, environmental, like I mentioned, but they might release $25,000 day one, no matter what. So they just pay the seller $25,000 just to give that seller confidence they're going to perform and close, where I really have not seen that as, a broker or a buyer here in Chicago at all.
Yeah, it's lenient here. What else? Some other differences on the buy side?
So on the buy side, like I said, I think competition is a big one. It's really tough to scale up. Once you go over a certain price point, call that 15, 20 million range, you're competing against institutional buyers and they just don't care about cap rates. I think cap rates in Chicago have been 50 to 150 basis points higher for similar type properties than even in other markets in the Midwest. It's just amazing to me that some of the properties that we've sold at Essex and I've seen other companies sell at the cap rates and quality where it's, an A or B location, great property built in the last 10 to 20 years, selling at a 5.5 or 5.75 cap, when that's a 3.5 cap rate in Phoenix or Austin over the last 12 months. So I think that's a lot of opportunity for somebody right now, but that's one of the biggest differences.
Got it. Do you see that let's say it's 150 basis points difference. And I know it's project by project and building by building, but just at a general statement, do you feel like that is worth the, call it, risk for, us being a blue state, tenant friendly, uncertainty with all the headwinds against us?
In general, yes, I do. I think it's well worth the risk when you're getting that much higher of a return. Also, I don't think the appreciation has been much different in, Indianapolis and Cincinnati compared to Chicago. The big difference is properties that are selling at 100,000 a unit in Indianapolis today, 5 years ago, were at 50,000 a unit. So you can say that Chicago hasn't doubled in a lot of cases over the last 5 years, but those properties were so beat up and so tired in Indy 5 years ago. So they've gotten a lot of appreciation, but there's a lot of appreciation in Chicago too. What's also unique about Chicago is the rental season seems to be more based around the summer here. So it's really like a May to August rental season for the most part. And in those other markets, it's more spread out. It's more like March through September or October. Nobody, the winters aren't as bad in either market. So it doesn't matter as much if you have a lease coming up in January, February. We're here, people do everything they can to avoid leases expiring in January, February. So given that we have kind of a shorter leasing season, it makes it unique. But it's also, the rent growth Chicago had this year, especially on the north side, was just as good, as not better than those other markets.
Let's talk about buildings, like actual physical structure. Yep. What are some nuances, some differences that you've seen being in these different markets?
I think there's a lot more of the older early 1900s builds in Chicago, especially on the north and south side. In the suburbs here, things started getting built for the most part in the 60s, 70s, and then expanded in the 80s and 90s. So I think similar as far as the suburban markets, because markets like Cincinnati, Indianapolis, they have a lot of those 60s to 80s builds out there, but their downtown markets aren't as built up as Chicago is. So Chicago has a lot more properties, especially throughout the city proper. And most of those were built in the 1900s, early to mid 1900s. So I think you have less of a concern in some of those other markets where, plumbing might be 100 years old, electric might be 60 or 80 years old. But here, most of the plumbing in those buildings have been updated, I would say, or at least the risers have been replaced. So it's just different. I don't think one's necessarily better than the other. It's just a little bit different. Got it.
Real quick, let's take your Columbus building. If you had to describe that area where I don't know where you are in Columbus, but what Chicago neighborhood closely mimics that area? Like for our listeners to get an idea of what Chicago neighborhood would you tag that as?
Yeah, so I'm a South Sider, so I'm going to say it's a kind of Tinley Parkish type feel. It's right outside Cincinnati. Actually, it's a town called Milford, and that's a 36 unit 1980s build. And I know, the Southwest suburbs had a lot of properties built in the 80s. So I'd say kind of a Tinley Park, Oak Lawn, Chicago Ridge feel. Got it. I keep saying Columbus. I know it's Cincy. My bad. No, it's good.
When going into these other markets, you're from Chicago, your network's in Chicago, your knowledge in Chicago. What did you have to do? What did you have to do to find your new network in that city and to feel comfortable enough to be investing there?
Yeah, started really with the brokers in the area, started building broker relationships. I started going to meetups in person in those markets. So if I was going to go down and, spend a day touring properties in Indianapolis, I would try to time it on a day where there's a local meetup in the area that night. And, that's where I made a couple of my best broker contacts. So it's really just kind of everything that everybody does here, go to meetups, attend networking events, just do it there. Indianapolis, I can get down to and from. It's only 3 hours away in the same day. Cincinnati is closer to 5 hours. So that's usually an overnight trip, but just try to take advantage of the time down there. And, every trip you go down to tour a property, set up 2 or 3 meetings, whether it's brokers or property managers or, local contractors. So every time we would go down there, we'd have a couple of meetings set up.
Got it. How many properties did you have to look at or make offers on before landing one of these?
I'd say the toughest one was getting that first one in Indiana. And we probably looked at and offered on, not that many, probably 20 to 30, I'd say, where, we toured, underwrote, offered either verbally or in writing, And then we just happened to find one within about the first 6 months that we were looking that kind of checked all the boxes. And so we jumped on it right away.
Got it. And as someone not familiar with the area, what's a Monday morning quarterback? We would have done this differently.
I think, when you're buying your first property, you always want to make sure that you're buying a good deal, but you don't want to always hold out for the home run. So you're not going to get a home run your first deal unless you get really lucky. So I would say, but on that particular deal, what I would have done differently, I would have had more money in reserves. Like I said, we had enough money to cover our renovation budget, but we were, a couple months before COVID hit that we closed. So we ended up getting by okay, but looking back, we said, we were really tight on our reserves there. Next time we buy a property, we're going to hold an extra couple months worth of bills in reserve. What
about like regulations compared to Chicago? Obviously, we got the Chicago CRLTO that we've all grown used to inside Chicago. The suburbs have many different scattered regulations. How does that compare in these other markets?
Very few regulations. Both of those states are very much landlord friendly. If you don't pay rent, you're likely not going to be living there too long. So tenants don't mess around as much. I think there is a lot more room here for the quote unquote professional tenants to, get into a building and then stay for a very long time without paying rent. Although I'll say overall on the, anything that I had or I was invested in the Chicago area, managed through COVID pretty well. I know some people, struggled quite a bit getting some tenants out and had some really bad problem tenants, but overall, anything that I was invested in or some of my close friends that have investments, they did pretty well.
Curious about the from a brokerage standpoint, I do feel that there's a small amount of brokers that do a majority of the deals here on the multifamily here in Chicago. Are you seeing something similar in those other markets?
Yeah, in Indianapolis, there's one broker, it's through Cushman & Wakefield. They control probably 50 to 60% of the market.
Wow.
And they have just massive market share, where the leaders in Chicago are typically no more than 20% of the market. So there are a handful of brokers. In Cincinnati, it's a little bit more spread out. One difference in Cincinnati is there's fewer larger properties, where Indianapolis has a lot of the 100 to 300 unit complexes throughout the suburban area. Cincinnati is a bit more like Chicago in the way that there's a lot more properties in that kind of 10 to 60 unit range and fewer in that 100 to 300 range. So because the properties are smaller, there's more local brokers that have, their hands in the mix. But in Indianapolis in particular, there's only a handful of brokers that are controlling most of the transactions.
It also, that kind of makes sense because, what's Indianapolis's population? Like 1 million, and the metro area is like 2?
Yeah.
2, 3. So like, the entire city is the same size as the south side of Chicago.
Yeah.
Right. Like, and our metro is 10 million compared to 3. Not that that's better or worse, but I can see how you almost can have a monopoly effect. It's a third of the size. Like you could cover the whole, I understand. It makes sense that there's less, it can be monopolistic, if that's a real word.
I would also say
it's like a real word.
It sounded smart. I have a monocle on.
I did. I'm like, before you rolled it out, I'm like, I never heard that word before. Oh, good.
You're going to use it all the time now.
Yeah.
Yeah, I will say it's both markets, or all three markets, are transactional. I think Indianapolis is probably the most transactional of the three. Chicago certainly has its properties where they, somebody buys it, rehabs half the unit, sells it over a 2 to 4 year period. Indy's had a lot more of that the last 2 years. Cincinnati, not as much, but people are starting to sell now. But I would say the rent growth has been pretty similar overall. If anything, I think Chicago's been a little bit better this year. I don't have the exact stats. They haven't come out yet, but just the rent growth that we're seeing in Chicago, just from the brokerage side, has just been absolutely crazy. And people talk about the taxes a lot, as a reason why they don't want to invest in Chicago. But, at Essex, we have a database going back 30 plus years of income and expenses. And so we can go back and look at what, percentage of the expenses, the taxes have been, over the last 30 years. And typically, even though taxes have gone up, income's gone up too. So you're still at that same, 35 to 45% total expense ratio, including taxes, just like it was 30 years ago. It's really interesting to see, even though one of people's main objections in coming to Chicago is taxes.
Yeah. I think I agree with the main objection being tax uncertainty. That one I get, but higher taxes I don't get, because it's you get a better cap rate. You get higher rents. Like, it's more, that part I feel is more than offset. I agree with the uncertainty aspect of it. Cause like if you're doing a syndication deal and you need to be out in 5 years and you don't know what that, that's going to drastically affect your NOI, especially on those bigger buildings. When you're just guessing on, it's risk. My taxes be $100,000, $150,000, like makes a big difference.
Well, you go down to a Texas market, taxes are usually 25 to 30% of the gross income. In Chicago, they're anywhere from 10 to 20 for the most part. So people are saying, oh, I don't want to go to Chicago because of high taxes. I want to go to Texas instead. Well, I mean, look at how much their taxes are there compared to, and you can't get insurance. Insurance here is probably, call it 300 to 400 per unit.
Yeah.
I've seen properties that are 1,000 to 1,200 per unit for insurance down in Texas. I mean, your total income percent for just taxes and insurance can be 30 to 40%. We're here, it's 20 to 25.
I had a conversation with somebody in Miami a few weeks ago, and he said the tax thing. It's like taxes. I got to deal with rent. I said, but for a single family home built before 1960 in Miami, it's going to cost me $5,000 a year for insurance because of hurricanes. Like that more than offset like his concern, like in that sense. And a lot of people, I don't know. Again, I think the news and the media puts it as a headline, and everyone gravitates towards it.
Yeah, and I mean, I heard your episode with Fritz Kagi a couple of weeks back, and for better or for worse, there's at least some transparency at this point. And I think going forward, people are going to have a better idea of what to expect and how to underwrite taxes on properties that have a lower assessed value versus what they're buying it for. So I think that argument is well worth the risk for the higher cap rate for me.
Yeah, absolutely. In the Fritz episode, for if you haven't heard it, 154. Great one. We had assessment, just a lot of behind the scenes on how we arrive at these numbers.
Yeah. So that was a great episode.
So Brian, you mentioned, tenants, they don't mess around because they know you can get them, if they're not paying, you can get them to leave. Are there other things you've noticed? Like, let's compare, I know Chicago's so diverse, but let's compare your South Shore building to, Northwest Indiana or Indianapolis. You go ahead and pick another market. Yeah. What are some other differences you're seeing in, call it, housing provider tenant relationship, like expectations that are different between the vast markets?
If you're in a bigger complex, call it 50, 60 units or up, you need to have some kind of amenity space because there's a lot of competition in, those markets, and having any kind of amenity like a pool or a fitness center or something like that will really help you retain tenants. But one thing I noticed is turnover in those markets can then be anywhere from 40 to 50% per year in some of the apartment complexes. And turnover is often a landlord's biggest expense. And I feel like turnover is also higher in some of those markets than it is in Chicago area for a variety of reasons. Part of it is because, interest rates were so cheap, people were buying houses, people transfer jobs, people move a lot. There's a lot of different options. So I feel like, although in those markets, there were less concessions during COVID, I think Chicago, especially on the north side, had to offer a lot more concessions during the downturn to keep tenants. But turnover as a whole is higher in some of those markets than it has been in Chicago.
Anything else just like in the day-to-day activities where tenants are certain expectations where you're like, whoa, my person in South Shore wouldn't expect this?
Yeah, I think if you can provide any level of just good quality management, then tenants tend to appreciate that, and you tend to have less problems with collecting rent and whatnot. As long as your property manager is in communication with tenants on a regular basis, if something's going bad with the property, just have them, hey, we have to fix this, a pipe burst, and there's going to be, contractors coming in over the next few days to fix this. As long as there's constant communication, I feel like anywhere you go, the property manager can really, make or break the property.
Yeah, I agree with that. I would chime in and say that the first, call it 10 days, right? The first, like the move-in process, are you taking care of them? Did you on the front end do all the usability check? I know, Mark, you guys do your checklist when someone moves in. Like, I think if you can set the right tone, you're going to be in a good spot.
Yeah.
And then when you don't, it's uphill battle for the next 12 months to
it's such
gain
an
their
uphill
trust.
battle. It's such an uphill battle. And the time put into that moving process is so key that a lot of people like, oh, I'll fix it after they move in. It's like, no, man.
No. Check the water pressure, make sure all the burners are working. Just all this, every door can close and latch, like all the little simple stuff that will start annoying people. And I
was explaining to it, the little simple stuff, to do a punch list of 10 or 15 little things that takes a few hours is going to be a lot cheaper than 5 or 6 work orders over the next couple of years, even if it's just so. Because if
a tenant has a bad experience in that first 30 days, they're going to not only leave the unit much quicker than they should, increasing your turnover costs, but they're going to cause a lot more problems. Then they're going to start talking to their neighbors. And then it's like a trickle down effect. So like I said, if you handle everything up front, making sure it's all working before they move in. I also found something that's very effective, a little just kind of gift bag of set of paper towels and a candle or something, or a couple bottles of water just for somebody moving in. Just kind of makes them feel, these people care about me, and just kind of gives them the warm and fuzzies as they're moving in. But yeah, those first 10, 15, 30 days are critical.
Yep. So Brian, you've seen multiple markets here. You've mentioned, cap rates and some other reasons why you're bullish on Chicago. Let's talk just at a macro level of the city. Forget about real estate for a second. Like, everything you hear in the news, you have crime, taxes, pension. Where's your head at there? Like, do you still believe in us being a, call it a top tier type city? Or do you feel like, hey, the city might be falling, but I can still make money on my rentals here?
I still view it as a top tier city. I mean, Penske came out, I think it was for 2021, and Chicago was a top 10 destination where people move to. So they pull out the report every year in which they say, hey, where are moving trucks going? Well, Chicago was in the top 10. And a lot of the people that move to Chicago each year are also college graduates in the Big Ten. So a lot of people who go to Ohio State or, Wisconsin or University of Minnesota or Michigan, they want to be in a bigger city, but don't want to leave the Midwest. Most of those people come to Chicago. So I think if you look at the rent growth or population growth over the last 10 years, it may not be as good as like an Austin or a Phoenix, but it's still really strong. And another benefit is, even though Chicago is growing at a little bit of a slower pace, the new construction is also at a slower pace than some of those other markets as well. I was down in Florida a few weeks ago too. There were cranes everywhere. I was down in Miami for just a weekend, and I saw probably 12 or 15 cranes. You don't see that as much here. The new construction has slowed down. So the supply and demand is going to work in landlords' favor. So I do still see it as a top tier market.
Yeah, it's like these old brick buildings are almost like a built-in barrier. You can't replicate that. You can't go build a 40-yard court, 40-unit courtyard building. It's not economical now.
Yeah. And also, as interest rates are going up, fewer people are buying homes. They're going to continue to rent. And if we're not providing the supply, there is a shortage of housing throughout the whole US. If we're not addressing that right now, that's only going to be in the landlord's favor as well. And I think that's actually going to work really well in anybody who owns in Chicago in their favor.
Yeah, absolutely. Yeah, I don't know. We have raising interest rates. We have potential recession. Are you guys still out there, regardless of market, looking at deals, right? Are you still active in the market and bullish just on multifamily as an investment?
Yes, active in the market, still bullish, being a little bit more conservative. The properties that I love right now, and honestly, it's some of the ones that I've seen the best deals on over the last 12 to 18 months, are the properties that have been built in the last 20 or so years. Everybody's always wanted value add over these last few years. They want to come in, do renovation and refinance, take out their capital in a couple of years, which is great. It's a great product. But right now, over the last 18 months, I think some of the properties that we've sold at Essex, some of the best deals people got were the ones that just needed a light value add, were a newer build, 10, 15, 20 years old, and just needed some cosmetic updates, nothing heavy, but you can lock in fixed interest rate for a long-term period, take off all that risk of construction and renovation costs. As we all know, supply costs have shot through the roof over the last 12 months, and construction costs have shot through the roof. So I think there's a lot of opportunity there still right now going forward. And that's where some of the best deals I've seen have sold the last couple of years.
Got it. Just real kind of down and dirty question. When you're doing those light value adds, so I know like you guys have done some of those, how are you structuring the finance? Like, are you getting something at a loan to cost? And explain that to our listeners. And then are you refining it out? Like, just kind of talk through when it's not like this big, hairy rehab.
Yeah. So I've done it a couple different ways. I have a lot of loans that are just fixed for 7, 10, up to 15 years. And where we've gotten just low interest rate fixed for a long period of time. And then we just brought in the capital for some renovations on the front end. A couple other ones were pure bridge loans, where did a, total bridge, renovated X amount of the units, had a construction loan as part of the loan, but then you have a floating interest rate. And then as the interest rates are going up this past 12 months, the cost of the loan gets more expensive, which means you can renovate fewer units than you were planning on. Or when you're going to refinance, you're going to get lower proceeds than you're expecting on, because nobody was penciling in 5.5% interest rates on a refinance 2 years ago. I mean, nobody was doing it. So a lot of these bridge loans are 3-year loans with 2 1-year extensions. which is fine, but it's still floating. So depending on what your floating rate is, it's a lot higher now than it was 24 months ago. And that's actually where I think a lot of opportunities are going to come for buyers in the next 6, 12 months.
Is buying that guy who has to get out of his bridge loan.
Who has to get out of the bridge loan, or not even that they have to get out of it, but they're realizing that if their business plan was to refinance it, they thought they were going to be able to get a certain amount of loan proceeds at the time. They're not going to get that. So they'd rather just sell the property, help the IRR because they're exiting in a shorter period of time, and versus refinance it with lower proceeds and keep for another 5 years.
That makes sense to me. I think kind of piggybacking there, another thing I feel will happen in the market is take the mom and pop who's owned forever, right? And, it's a 12 unit building, whatever. They had the option 2 years ago, a year ago, hey, like I can sell this or I can just refinance it at 3% and sit on that forever. And option B is now out the window. So if they want access to their capital, yes, they can still refi, but it's not as attractive as an option. Whereas and now they might be more lenient towards, all right, well, let's actually get rid of the building.
Exactly. We typically underwrite about 400 properties a year here. And so we see people, they just want to know what their value range is. Some people want our proposal for a refinance purpose, and some people decide to sell. But as you said, a lot of people over the last 3 to 4 years that have decided to refinance because they're getting at 3 and 3.5 interest rate, they're making more money than they ever have before. Not only did they take a chunk of capital out of it, but their interest rate is so low that their profits are as high as they've ever been. So their mindset is always, well, why would I want to sell? Well, now that's a little bit different. If you're going to go in for refinance today, you're going to be somewhere in the 5-ish% range. Your loan proceeds are going to be lower because it's all based on debt coverage ratios. So you're not going to get as much out of the refinance as you thought, and your interest rate is higher. So your cash flow is lower too. So that's going to, push a lot more people to sell, I think, in the next 24 months versus refinance.
Will the buyers be there to buy?
I think so. I mean, look how much money has been printed the last few years. There is still so much capital out there today that I think the demand is still really strong. And oddly enough, in the brokerage side, we're on pace for a record year. We have not seen activity like this over the first 7 months of the year. This is towards the end of July when we're recording this. We've not seen the activity in years. So whether it slows down a little bit the second half of the year, we'll see. I think some buyers are moving to the sidelines for a bit. But I was actually talking to another broker friend of mine just last week, and he was saying it feels like COVID, where a lot of buyers are just kind of sitting on the sideline waiting to see what happens with all of the uncertainty. But that's where some of the best deals happened. 2 of the best deals that I bought were in, summer of 2020. So I do think there's opportunity today as well.
Yeah, I agree. I'll go on record saying I agree. And then when I'm wrong, you guys can all point a finger at me and say you were wrong. That's fine.
Yeah, I'll take that finger point too, because I think there's a lot of opportunity right now. We're going to likely go into some sort of recession if we're not already in a recession. But I'm hearing people talk about, the biggest buying opportunity of our lifetimes coming up in the next 12 months. I just don't see it. I don't know. I mean, I think there's too much demand out there still. I think people want and need to buy income producing properties. I think the tax benefits are still really good. We still have 100% depreciation in 2022, and it's still going to be 80% bonus depreciation in 2023. So there's a lot of benefits to continue to buy as long as you're buying, good quality properties. And I think the biggest risk is those really heavy value add renovations.
Well, I think for anything to be you hear the best opportunity of our careers, you have to have something that is crippling on our world. And I'm not sure I could see anything that's so extreme. Crippling meaning like the Great Recession where there's nobody would lend $1. Yeah. You could even get it from Guido on the side of the corner. Like he was even holding back. Or you have to have some inflation so out of control. Like you get inflation. I think it's been pretty tame the last couple of decades. So some of this is just kind of because the printing, some of it's just because it's due time, but it's not crippling. Like something crippling has to happen for something extreme to happen.
Yeah. And prices can go down, right? But when people say the biggest buying opportunity, I think the biggest buying opportunity is when you get blindsided and no one sees it coming, right? That's if there's 5,000 YouTube videos about the biggest buying opportunity, everyone's sitting there waiting with capital.
Yeah.
It can't be the biggest buying opportunity. We're all, that sounds competitive to me.
Well,
the biggest buying opportunity is when you're blindsided, no one sees it coming, and you're the only one in the room saying, "I'll buy."
I've been saying this for many years now. In 2007, 2008, everybody I knew, everyone had no money in the bank. They were borrowing 110%. They were borrowing
and
from.
No one was saying the biggest buying opportunity is coming.
No one was talking. No one was talking. They're just saying that the real estate's going to go up, up, and up. That was the whole. That was the whole theme back then. Like, oh my gosh, you got to buy as much I can today because tomorrow it's going to be worth 20 grand more each unit. And like for the last 5 years, all I've heard is people like, oh, I'm saving up all my money. I'm waiting on the sidelines. Like nothing crippling was going to happen when people have cash in the bank.
And also part of what caused that recession was obviously the 110% loans, but everybody was getting into a adjustable mortgage rate. So they were all doing these 1, 3, and 5 year adjustable rate mortgages and just, cashing out every 3 years when the rate comes up. Well, over the last 5, 6 years, I don't know anybody who's done an adjustable rate. The rates are at, 2.5%, 3% for a couple of years. Everybody's putting on fixed debt. So there's not going to be that shift, at least in the housing market that I see. Interest rates going up is going to affect supply and demand a bit, but yeah, I don't see that major crash coming that some people are hoping for.
I think my bigger concern, I've noticed this out loud. I think my bigger concern is not buying enough stuff here now because it's only going to get tighter. Or my biggest fear, I mean, we could have an entire like real estate changing like economy, like where you end up like England, where it's just like everything's like you get a 1 or 2% type cap rate. You might as well be in a savings account. Like the world can change that way a lot faster than it could be some other earth-shattering type crash.
Yes, like the Neil Bawa is like we had like the offline conversation with him. Like that opened my eyes when he's just rattling off countries and their cap rates. And it's like, oh, we are unique here in the U.S. that you can get these type of cap rates, whatever market you're in.
Because think about what's happened in the last 10 years. You've had all these different, I always generalize it as Wall Street. All that type of money finds like, holy shit, there's a whole corner of this world of, I mean, whether it be buying companies or property management companies or real estate or like all that stuff that they've gone crazy. And that money doesn't slow down for the most part. That money is always circulating somewhere, getting borrowed from cheap. And the more that money gets pumped into our system, and they also have the fail-safe type systems in place too. If one of these hedge funds has a couple $1 billion with a bank, the bank's not going to say, you know what, let's just take all that real estate back, like, and sell it to you guys over there and give you a good deal. They're going to rework those terms. They got so much leverage. So like, I can see this world going more towards that, and squeezing out the little people like us than anything else as just a future in real estate investing altogether.
And Mark or Tom, you mentioned Neil Bawa. He always points out too in his interviews that the Fed raised rates, I think 9 times between 2014 and 18, and cap rates continued to compress the entire time. So that's one of his big talking points, and why he doesn't think that rising rates are going to affect cap rates too much. Who knows? I think it'll shift a little bit still, but he points that out all the time.
Yeah, I wouldn't underwrite that way, right? I would underwrite the other way, but if that happened, I wouldn't be, oh my God. Like, I guess nothing would shock me one way or the other.
Yeah, for sure.
So cool. Let's wrap this.
All right. Awesome. So
put a bow on it.
Yeah. I'll ask the question in a little different way. What is your competitive advantage as a Chicago real estate broker looking in different markets?
I think the biggest competitive advantage is that as a broker of 15 years, I know how to find property owners, look up properties, do all that research on the back end. So I've been able to put in a couple processes in place where, pull property owner lists of other markets, put in mailing campaign, have a virtual assistant, do the research, all that kind of stuff. So I think putting in kind of my brokerage prospecting process in place in other markets.
So that skill set is transferable, you're saying. I love it.
Absolutely.
Awesome. Brian, what's one piece of advice you would tell someone that has yet to buy their first property here in Chicago?
Make sure you have the right team around you. I mean, if you came across the perfect deal today, can you buy it? You want to make sure that when an opportunity does come up, that you are prepared. So get prepared. Have, your lender in place, have your insurance broker in place, have your contractor in place. Just make sure to have the right team around you to be able to execute when you do come across an opportunity.
Awesome. That's a great question to ask.
Awesome. So what do you do for fun?
Well, in the winter, I love Chicago, but not so much in the wintertime. So I do like to get out of town for a few weeks at a time in some warmer climates. San Diego, especially, love Miami area too. In the summertime, I enjoy golf, but I'm terrible at it. So I'm trying to take some lessons to at least become passable. So if I go to any golf outings, I'm not, holding back the team. So, I would say travel in the winter and golf in the summer.
There's always one other guy that I've always been lucky. There's always one other guy that sucks just as much as me at golf.
Yeah. It's the worst when you're on a team of, three ringers and then you just like shanking away. So
yeah. So maybe I do due diligence on who I'm going with, but there's always one guy that sucks.
You make a putt or two though, and you feel good about yourself.
Yeah. Best ball. I'm all about playing best ball. You get a few of those and a few of those best balls, and you're okay.
Exactly.
So, Brian, a good book, podcast, or self-development activity that you'd recommend to our listeners?
I'm going to go with the self-development activity. Over the last 12 or 18 months, I've really made a point to read and meditate pretty much daily. So I wake up early as it is. I'm always up by 5:30 or so in the morning, and just spending 30 minutes, reading 10 or 15 pages of a book and, trying to meditate a little bit just really helps kind of calm me, relax me, and get me prepared for the day.
Besides yourself, name one person in your local network that you'd highly recommend to other investors as a quality resource.
Yeah, I thought about this, and it's tough because I have a lot of people in the network, but I'm going to give my friend Kevin Claffey the chance here. So he's an insurance broker with Provident Group. And not only does he do the insurance for most of my properties, he is also an incredible connector. He's got such a big network that, he can help connect people with other people depending on what they need. And insurance is something that's really important right now. That's changed a lot since COVID. So I think, we're seeing underwriting properties that still have insurance at 200 per unit, where we know it's going to be 400 a unit going into it for the next buyer. So It's something that's a changing market. People overlook it, but Kevin's a great guy, great resource, and he's connected me with multiple other people that I've worked with.
Got it. What was the last name?
Kevin Claffey at the Provident Group.
All right. Sounds good. We'll link to him in the show notes.
Awesome.
Brian, thank you so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
They can come to our website at essexrealtygroup.com or my personal website, which is at arcequitygroup.com as well.
Good. Awesome. Mark, who bought something?
Angelica Jones out of Bridgeport bought a t-shirt.
All right. Nice. All right. I think you can do this one. And if not, Brian could help you. So Chicago is home to 4 universities that have D1 athletics. Name those 4 universities. D1 athletics within the city limits. So Northwestern is not an answer.
University of, hold on. University of Chicago or Illinois, Chicago.
That's 1.
Loyola.
2. Got another Catholic one. Down in Lincoln Park.
Oh, yeah. DePaul.
Yeah, 1 more.
Kind
of down by Pullmanish.
Oh, so Olivet?
No.
Yeah. What's the one on 95th?
Yeah.
That's what I meant. I can't think of it.
It's not really a state, but it's
Chicago State.
There you go.
Yeah. I drew a blank. But Olivet is you see that's right behind that campus there, and you see it from the highway. That's why it popped in my head right away.
Yep. Need a little help, but we'll give it to you.
No. All right.
Keep the streak going.
Angelica, you get.
We want to hand out Renovo's money as much as possible.
Yes, exactly. All right. Thank you very much, Brian. Welcome back, and thank you for coming back. And Tom, thank you as always. Listeners, if you found Brian added value today, please take 20 seconds to give us a 5-star review. Reviews equal exposure, equals ability to provide more and more value to our listeners. You like that? That was what I read when last time you were on the show. That was our original kind of ending. So I thought, since you're one of the first 15, I'll bring that saying back. But
I think our first 20 guests should get shirts with the logo, and it just says OG.
OG. I love it. Awesome.
I like it.
Brian, thank you very much. Tom, thank you very much. And listeners, we'll see you next week.
Thanks all.
Thanks, guys.